The topic of today's conversation is hyperinflation, and we'll be discussing this with an expert on currencies, the history of monetary policy, and of course, inflation. Steve Hanke is the professor of applied economics at Johns Hopkins University, and he joins us today. Professor Hanke, welcome back to the show.
Good to be with you, David.
Professor Hanke, you and I have spoken about hyperinflation and inflation many times before, but I like to bring it up again because something happened on Twitter, and you were involved with this. So Jack Dorsey, CEO of Twitter, he tweeted on October 22nd that hyperinflation is going to change everything. It's happening. To which you responded, why Twitter CEO and crypto investor Jack continues to make unfounded assertions about impending U.S. hyperinflation is beyond me. Hyperinflations are rare birds. Indeed, the U.S. has never experienced hyperinflation. Actually, he responded to that tweet too. He said, does that mean I can't join a cryptocurrency board? Well, this is a tongue-in-cheek aside, Professor. How would you respond to Jack if he were speaking with you today?
Well, I think what we have here is a situation where, and this happens a lot on Kitco too, by the way, is that people play fast and loose with language and words like hyperinflation, and they don't actually know what they mean. What he was trying to express, I think, is that he just thought inflation was going to be a lot higher in the United States than it is at present. It's running about 5.4%. And he finally clarified himself and said, well, maybe it's going to go up to 15%. I think that's probably not going to happen. But let's talk for a minute about hyperinflation and the importance of words. And since 1956, Professor Phil Kagan at Columbia had written a classic article in 56 in which he defined hyperinflation as an inflation that is 50% per month, 50% per month or more. And that has been the custom and practice professionally in the economics profession ever since. So that has become the definition. Now, I've refined that because I have better measurement techniques than Kagan did. And so for me, now the definition is 50% per month lasting for 30 consecutive days. That's hyperinflation. And I'm in charge of the World Hyperinflation Table, which was published in the Routledge Handbook originally. Nick Cruz and I did that work. And now there are 62 episodes that qualify that we've been able to document and scrub down and so forth. So let's talk about this for a minute. 50% per month. What does that equal if you had 50% per month running for a whole year? The inflation rate for the year would be 12,874.63%, almost 13,000%. Now, obviously, Dorsey was not thinking in those terms. There's no way. I mean, he wasn't saying that we're just about ready to have a 13,000% inflation in the United States. But that's what would have to occur to qualify on an annual basis for hyperinflation. So where have we had these kind of big inflations? If you look at monthly inflations, and remember, over 50% qualifies as a hyper, and we've had 62 episodes in the world history of this. The one everybody knows about is Germany in 1923. Of course, they don't know any details about it because most of the people who talk about these things actually don't have any factual basis. You know, it's basically fake news when they start talking about hyperinflation. Germany, monthly inflation, 1923, 29,500% per month. That's when it peaked out. It was an important hyperinflation, but it wasn't really a big hyperinflation. Now, one I measured personally because in 1990 I was a chief economic advisor in what was Yugoslavia, the Socialist Federal Republic of Yugoslavia, and in 1994 in January I measured the hyperinflation rate at 313 million% per month. That's 1 month. Now that was a hot hyperinflation. It was the third highest in world history. So that's pretty much it on hyperinflation. People have to know what the definition is.
Right.
Be careful when they talk about it. If you read, I've got my Google alert set up for hyperinflation. I'm getting stuff every single day where newspapers and so-called experts are talking about hyperinflation, and they just don't know what they're talking about. I mean, it's just baloney.
Let's do some brainstorming, I guess. Suppose we were to have hyperinflation per the textbook definition of 50% per month in the United States. What would have to happen to the money supply, to the economy, to monetary policy to create that kind of an environment, 50% a month?
Well, 50% a month. Let's just go through the hypothetical exercise. Since COVID in February of 2020, the money supply has increased by about 35%, a little more than 35%. So that's 18 months, 35%. You would have to have over 50% money supply growth in 1 month to rev up the consumer price index. You'd probably have to have actually the money supply going up for over 50% for a number of months before you'd actually rev up. There'd be a lag. You would increase the money supply by over 50% per month for a period of time, let's say a quarter or a half a year. Then in about 18 months, you would probably get a monthly inflation that would be up around 50% per month. So it's just completely unreasonable. Now, let's talk about the United States
Yes.
and where, in a sense, Jack Dorsey and I agree. In other words, Jack Dorsey is basically saying, look, he got everybody's attention with his fake news that he put out on Twitter. Okay, it's interesting that actually he took down the majority leader in the House, Kevin McCarthy, in July had said something about, he had a tweet about inflation in the United States. Inflation is a big problem and so forth. Anyway, Dorsey took the thing down. He censored Kevin McCarthy.
All right.
Okay, so then he turns around and starts tweeting about hyperinflation. But what he was really talking about is just more inflation, which is the same thing Kevin McCarthy was complaining about that had been censored by Dorsey. But anyway, here's where Dorsey and I are on the same page. Dorsey and I don't think the current inflation we're seeing is a temporary inflation. We don't think it's only caused by supply chain glitches and so forth. Inflation, as you know, I've repeated this 1,000 times on Kitco, according to Milton Friedman, and it's correct, is always and everywhere a monetary phenomenon. You have to have the money supply growing fast. And then you have inflation eventually, after about 18 months of that fast growth in money supply, the inflation grows. So let's look at it. John Greenwood, who's a chief economist at Invesco in London, and I had actually an article last Friday in the Wall Street Journal about the bathtub. So envision a bathtub, and you're filling the bathtub. The faucet is a money supply. So the money's coming in the bathtub. So the question is, well, how much money has come into the bathtub since COVID? And about $5.5 trillion worth of money measured by M2 has gone into the bathtub. Then let us assume that they start tapering right away, the Fed, and they get the money supply growth down to about 6.5% per year. And that continues till the end of 2024. That's another roughly 5 trillion that you're putting in the bathtub. So you have 10.5 trillion in the bathtub. Now, what about the drains in the bathtub? How does that work? You put the money in, but some is drained off to fuel real economic growth and economic activity. Now, given the numbers that we have, and they're pretty good numbers, that drains off by the end of 2024. That would drain off about $1.5 trillion. There's another drain. Money is demanded. As the economy grows, people demand to hold more liquid assets, more money, larger money market funds, more cash, et cetera, et cetera. That will drain off about $2 trillion. So if you subtract the 3.5 trillion from the input that's gone in to the tub of 10.5, you end up with about 7 trillion that's left in the tub. Now that's excess money that will go eventually, after about 18 months of being in there, into the overflow valve. And the overflow valve is really the inflation valve. So we have baked in the cake already, no matter what happens, a lot of inflation is going to be going out of that overflow valve. 7 trillion out of the 10.5 trillion that actually has gone in will go into the inflation overflow valve. So in that sense, I'm certain Jack hasn't analyzed the thing in quite that kind of technical detail, but the point is that is consistent generally with the fact that we will have more inflation, which he's worried about. Now, he says 15%. If you actually look at the numbers I gave you and work the thing out, you get more like 6%. And we've said this before.
Yeah, 6 to 9, right? Could it go to 9?
No, I don't think it's going to go up to 9, but let's say roughly around 6%.
Okay.
For 2022, 2023, 2024. That's permanent. That's persistent. Persistent. Right. It's not temporary. It has nothing to do with supply chains. It has everything to do with the money in the bathtub.
All right. I like to.
Actually, David, the excess money in the bathtub.
I understand.
The Fed has just made a catastrophic error since COVID because they have not been looking at the money supply. That is not on their dashboard. They are not looking at this. And in fact, you pointed out, actually, originally in February, when we did an interview, that Chairman Powell indicated in a testimony that the money supply didn't make any difference anymore. I mean, a fantastic statement. Just ridiculous.
He said we should unlearn monetary policy, or monetary theory.
Yes,
rather.
Exactly.
Unlearn monetary theory.
No. If I was the president and reappointing the chairman of the Fed, I would indicate to the prospective chairman that they should be learning monetary economics before they could be appointed.
Okay. I'd like to understand, just in your example of, you brought up earlier Yugoslavia back in the 90s, 300 million% inflation per month, was it, that you said? How did people survive that kind of environment? Like let's say you lived in that kind of a country, that kind of place, in that economy, how would you get by?
So, well, poorly, to make a long story short. But what they did is that the Yugoslav dinar, if you were paid in Yugoslav dinars, you would get rid of those like a hot potato and exchange them for Deutschmarks in the black market. So that's how you survive. That you have enormous spontaneous, what we call dollarization going on. Currency substitution. Whenever you get a hyperinflation, you want to get out of that junk as fast as you possibly can and get something. Now it's usually the dollars. And in Yugoslavia, the tradition was you always had about 1 million Yugoslavs working in Germany all the time. Even in the communist era, the border was open in Yugoslavia. So Yugoslavs worked in Germany. And what did they do? They sent Deutschmarks back home. So the economy was very heavily Deutschmarkized anyway. So there were a lot of Deutschmarks around and you could get your hands on them. And when the hyperinflation took off, you really went after those Deutschmarks big time. And so everything, the economy changes. Everything was priced in Deutschmarks. You couldn't really go in and see Yugoslav dinars on the price tag of an item, because it would be stupid for a store to be wasting their time putting a price in Yugoslav dinars.
The government didn't intervene and said this is not allowed?
Well, yeah, yes, but do you think anyone obeyed the orders?
All right. Okay.
And,
So essentially
how
it was kind of like a currency board. I mean, not technically, but in the sense that the entire economy was pegged to another currency, right?
well, no, what it's more like is a fully dollarized economy where
Right.
in fact the local currency, the Yugoslav dinar, just didn't exist. Now, what we did, by the way, I was the chief advisor to President Djukanovic in Montenegro and a state councilor in Montenegro. And in 1999, Montenegro was still part of the rump Yugoslavia. And to get away from that junk Yugoslav dinar, we officially made the German mark legal tender in 1999, December of 1999. And so we dollarized Montenegro officially, but unofficially, it had already spontaneously dollarized or Deutschmarkized anyway. Everyone was using the Deutschmark. You couldn't buy anything in Montenegro. You could pay in Yugoslav dinars, but the price tag was actually in Deutschmark.
Well, in the United States, we're not going to have hyperinflation like you explained in detail. But, 6% inflation persistently is still rather high for some people. Do you see some people doing similar things as they've done in Yugoslavia, which is to throw away their local currency, in this case the US dollar, and buy something else, hold that?
Well,
could that happen here?
No, 6%, number one, is 3 times higher than the inflation target of the Fed.
Right.
So it's a very high inflation.
Right.
I mean, the highest inflation we've had since the Second World War is only 15%.
Yes.
So it's getting, it's almost halfway to that point. So the point is, what do? Well, you buy inflation hedges, you buy commodities, you buy a house, you borrow a lot of money. Why do you borrow money? Because you're going to pay it back in cheap dollars.
That's right. Well, interest rates are going up. I don't know if that's my bank over here in Canada just raised their variance, so I don't know if it's a good time to be taking out debt.
Well, the money supply has been a lot tamer, the growth in it in Canada, and the inflation will not be as severe in Canada as the United States. Okay. But anyway, you get into hard assets. It's a hard asset play, because in inflation, hard assets always do well.
Final question, Professor, before I let you go. If Jack Dorsey ever invited you to participate in a cryptocurrency board, what would you say? Would you accept the invitation?
Well, yeah. I've always advocated, by the way, for a cryptocurrency board. A cryptocurrency board, if one was put in, and the anchor was the U.S. dollar, for example, you would issue a crypto. It would be equal to $1 US. It would be backed 100% by US dollars. It would trade at a fixed 1-to-1 exchange rate and be perfectly convertible and credible. And Dorsey would be a beautiful chairman for that thing. I'd of course be on the board. I've already designed the thing. I have the draft law in my back pocket.
Well, that sounds like a stable coin. Yeah.
Well,
sounds like what you're describing.
It's stable coins are kind of what I call phony coins. What I just described to you would be the real deal. These stable coin people don't actually know what the hell are doing, quite frankly. If this kind of cryptocurrency board was put in, and if Dorsey was the chairman, believe me, that thing would take off to the moon.
Right. Well, central banks all around the world, just final topic I wanted to hear, major central banks are creating their central bank digital currencies. So they'll probably be thinking along the same lines as you, Professor, and creating some sort of CBDC digital currency that is more or less stable, tied, anchored to some reserve currency, US dollar, gold, doesn't matter which, right?
Well, They have been, and they're planning, and a couple of central banks are actually experimenting with digitization. But that's digitization of actually their own currency. It's not really a currency board. I mean, it's just digitizing the. For example, if we did that in the United States, or let's say you did it in Canada, you just digitize a loonie. So it would be the same, only electronic. But the point is, we already do that. We're already digitized. Most transactions in U.S. dollars in the United States, they take place electronically. So in a way, a lot of this conversation is by people who actually don't know what they're doing, and they don't understand banking.
I meant to ask you this. Yeah.
We're already basically digitized in the United States. Period.
I meant to ask you this. If the U.S. were to introduce FedCoin, which is the U.S. version of a central bank digital currency, isn't that an addition to the money supply? I mean, I don't know where they would count that as part of M2 or M4 or whatever, but isn't that just creating new money? How would that change the money supply?
It wouldn't.
It wouldn't? Okay. Why?
No, it wouldn't. It would just digitize it instead of let us say that this is a hypothetical now, but let us just say that the Fed says, look, we're gonna go cashless. We're not going to have any notes and coins anymore. None. Everything's going to be digitized.
Mm-hmm.
Well, that would still be a liability. That you have to look at the Fed's balance sheet. That digitized dollar is just a liability of the Fed, exactly like notes and coins are a liability of the Fed, and nothing would change except you just wouldn't have any physical money anymore.
Yeah. So bottom line, a Fed coin would not make inflation go higher because it's not adding to the money supply. That's what you're saying?
Well, assuming they replaced, if they took away physical notes and coins and digitized them, and that's all they did, then the money supply doesn't change. The liability on the Fed's balance sheet doesn't change. The money supply doesn't change. Nothing changes except the modalities of using the dollar. It would be digital rather than physical.
I understand. Okay.
But remember now, the key thing here, right now, digitization and electronic money in the United States is way more important than physical notes and coins. Physical notes and coins are peanuts. We now are almost all the great bulk of transactions, it's all electronic now.
Okay, yeah, it's a good point. Professor, thank you for your insights. Thank you for your explanation. Great thoughts as always. See you next time.
Good to see you. Yeah, have a great weekend, David.
You too. And good weekend to everybody watching the show. Thank you for watching. I'm David Lin.